All right, we are live. Those of you who I haven't met, my name is Charlie O'Donnell. I run NextNYC, former VC of 20 years. I guess still technically a VC. I have a portfolio. Not all of my companies have shut down, which is what we're going to be talking about today. Lots of live and active and thriving ones, but not all of them go according to plan. And sometimes, even when things don't go according to plan, you can still make something of it. Sometimes get your money back or some portion of it, find the team at home, and that's what we're going to be talking about today. I'm going to let my esteemed panelists introduce themselves. So you're in Melissa, Brendan, and Sam on my screen. I don't know if everybody has the same lineup. So Melissa, why don't you kick us off with an intro?
Excellent. Thanks, Charlie. I am Melissa Marks. I am a partner at Gunderson Dettmer in New York. And for anyone who doesn't know, Gunderson is a law firm specializing in the innovation economy. So I'm going on almost 20 years representing founders, tech companies, venture capitalists when they are, raising money, making investments, but also all of the corporate governance issues that come up along the way, including the topic that we're going to be talking about today, which is, the exits that nobody dreams about, but which still happen frequently.
Fantastic. Thanks. And Brendan?
Hey guys, I'm Brendan. I am the founder and CEO of a company called Sunset. So we help primarily venture-backed tech startups wind down and find soft landings. So yeah, not the most popular at founder dinner parties, but here we are. But excited to be here.
Awesome. And I'm Sam Cates. I am a partner at a firm called Positive Sum that we started about 5 years ago. We've raised 3 funds and we focus across stages in a variety of industries. A lot of my experience relative to what we're going to talk about today is actually from the 6 years I spent at GE Ventures before starting Positive Sum, where we both wound down GE Ventures, but also had a number of portfolio companies that GE would invest in over the years and then would end up in situations where they needed to find a strategic exit or something else. And we were the ones maybe most active and most resourced to help with that. So got a lot of rep in that period.
And Sam was a co-investor of mine in a Brooklyn Bridge Ventures portfolio company and really went above and beyond as a partner. And, I know that VCs are renowned for doing a lot of work on companies. And so I know that's something you expect from a lot of VCs, but Sam's effort was particularly stand out, and I appreciate it. And that's why
I think I get too much credit for the founder that our friend put in, but I appreciate it. Yeah, it was a much better outcome than either one of us can hope for.
Yeah. So let's just start off with signaling, right? Because obviously, well before a company runs out of money, there are signals that you're maybe in a salvage some value situation rather than let's pivot or adjust strategy. And for both founders and investors, we'll sort of go around. If each of you can kind of contribute based on your experience, a sort of warning sign that hey, might not be able to turn this thing around and we should be in salvage value mode. Melissa, I'll start with you.
Just because I'm...
No, go ahead.
Yeah. I might be the person that's supposed to sense that first and say, hey, we should call Brendan and we should call Melissa. And frankly, that's where teams get it wrong, boards get it wrong, both investors and generally speaking, and this is a rule that we don't follow enough, is I think of it as if we have 6 months left to run the company, ideally we're talking about it at 12 months, but really if we're at 6 months and we don't have a really clear path to either raise more money or get profitable or one of those things, then we need to be figuring out what steps we're taking towards an exit, towards some kind of salvage opportunity. But I'd be curious if I've got that maybe a little too liberal or conservative based on the people who have to then help us accomplish that.
Actually, I think that's pretty spot on, with the caveat that, in my experience, when founders are told 6 months, often what that ends up meaning is, okay, we're at 6 months, let's spend a couple months, thinking a little bit more, and then you're down to 3 months. So I would say if you're at 9 months is probably the right time. And you're having, we're talking about raising funding, but it doesn't feel like you have the metrics to raise on yet, or you had an unsuccessful fundraise, that's really the time to start talking about your options, because they definitely decrease drastically as time goes on.
Yeah, I totally agree with Melissa on the kind of the 9-month mark. I think another thing that often founders might not realize is like the zone of insolvency. So when we say like 9 months, that's like when you're really just doing the very simplistic like burn and runway math. But if you actually had to, if you couldn't sell your assets or anything like that, like how much you need to pay out for like unused PTO? Are there like annualized contracts that you need to pay out? Are there customer contracts you need to pay back? So sometimes we see founders who are like, cool, we still got 3 months. And you actually do the math and you're like, oh, you're actually in debt like today. So I think, again, the longer 6 to 9 months is like great to start having those conversations.
Yeah, and one of the things I might add too, especially there's the like, at what point you should start to have the conversation, and also like what kind of conversation it is, whether there's some recoverable value. Partly also depends on like what you've built up until this point, right? Like, is it viable by somebody, right? Like if you raised 18 months of capital and you spent the first 9 months trying to build something that literally like didn't work, isn't a useful product to anyone, that's a very different situation than like, here is something that someone else could potentially use. Melissa, Brendan touched upon a couple of things that companies are obligated to see through. And I wonder if you can just sort of touch upon some of those, like, I've signed a 1-year contract, but I did that a month ago and I only have 6 months of cash left and people have paid me up front. What are some of the obligations I might have? Can I just, give the money back? Am I going to be strapped to the deck of this ship, supporting my SaaS company for a year because somebody signed a year contract? What are my requirements to sort of see through?
Yeah, it's a great question. And there's kind of a hierarchy of obligations in these situations. So, the first thing that I always counsel boards of directors to think about are the obligations for which they could potentially become personally liable if there is truly no cash left. And those are things like taxes and employee wages. Those are the two big ones. So you always, when you're doing that cash burn exercise, really want to make sure that if you are getting close to the point where you cannot pay your employees for the work that they are doing, you're going to want to terminate their employment, or in some cases furlough, but that's a topic that is, misused a lot of the time. Don't ever have anyone work a day that you cannot pay them for. It's just a very messy situation.
And
yeah.
Go ahead, Melissa.
I was going to say, after those kind of potential personal liabilities, you look next at, do you have any secured creditors? So that would be like a bank lender or someone who actually has a lien on your assets. That's kind of the next level of priority, because they actually are going to have a voice in what happens next if you do have those creditors, because they potentially could take the assets and be the ones to make the decision about what happens if you're in an insolvency position. But if you're ahead of all those things, then you're really in the world of dealing with your day-to-day liabilities. And so those you can try to negotiate your way out of. For example, like if you know that you have, a 1-year contract that you're obligated to pay monthly and you're not going to be able to do that, you can try to call that vendor and negotiate a payment to end it early. And that's often what happens, as I'm sure Brendan can tell us about in these situations. There's just a lot of kind of negotiation to try and get people to accept some amount of money on the dollar, terminate those obligations, and walk away cleanly. I think one last category to put out there is your obligations to your own customers, particularly if you have people who are on subscription plans or things like that. And that's another thing that you're going to want to get out ahead of, not just for legal liability reasons, but also for reputation of it as well. Make sure that you give people notice ahead of no longer being able to provide that product to them. That's the way you're heading.
And before I ask Sam a question about just barriers to getting into this and admitting the situation. Brendan, Melissa mentioned employment, and especially in sort of a post-pandemic remote world where people are sort of working all over the place. All those rules aren't necessarily consistent across states, right? Like you sort of have to keep track of where people are working.
Yeah, definitely. I mean, yeah, every single state has different employment practice, regulations you need to follow if you're going to do any type of layoffs, mass layoffs. You also need to, depending on the size of companies, a lot of times we're talking about much smaller, but you have to be looking out for the WARN Act if you're laying off much larger groups of people at any given time. So yeah, when you're obviously if you're drafting up a bunch of separation agreements, you're definitely going to want to consult your counsel on how to best do that based on all the different states folks are in. The only other thing I just want to mention, just kind of piggybacking off Melissa there, is personal guarantees as well. So Melissa was kind of talking about personal liabilities, things that can pierce the corporate veil and hit the directors, both the investors and the founders. But a lot of times what we see too is the founders will sign up with a Bank of America credit card or a Chase credit card or an Amex credit card and not the Brexes and the Ramps, or they will sign a lease and unbeknownst to them, there's a personal guarantee on that lease. And personal guarantees are just mean you're on the hook personally if you cannot pay off those outstanding debt obligations. And so that becomes very tricky as well. So yeah, and maybe the last thing on that is what's really tough, especially what Melissa was saying with unpaid wages. Once you get into these categories, the help that you're looking for will actually not really be there as much, right? Like Sunset won't be able to work with you. A lot of ABC firms won't be able to work with you. Like a lot of people that you would normally go to help you actually can't once you get into some really sticky situations. Anyway, sorry, I went on a tangent, but yeah.
No, appreciate it.
What is the difference between Sunset and the ABCs? Maybe it's worth just like saying what an ABC is first.
Yeah, absolutely. And ABC stands for assignment for the benefit of the creditors. And so that is a process where a lot of venture-backed startups will go through that when they are typically insolvent. Insolvent meaning they have more debt obligations and they have cash on hand. And the benefit of that process outside of it's a alternative to bankruptcy. So instead of going through the court system and following all that their proceedings and being in kind of the public eye, you can privately choose an assignee. So you can take all of your assets, liabilities, you can assign it over to this person, this firm, and they will actually go and first act as like an investment bank. They'll try and sell those assets, and then they will deal with the remaining creditors based on the remaining cash on hand. So we do not get assigned all of your assets or liabilities. We do not become a fiduciary at Sunset. We do more of a managed wind down, whereas the ABC firms do that. So that's high level.
So Sam, both investors, and you made a good point that like clearly an investor should be the first one to say, hey, maybe we're in this situation. What gets in the way for both investors? There's a certain like hopefulness to venture capital. We're planning for things to work out. We hear these like, apocryphal stories of the last second turnaround and all of this sort of stuff. But what are some of the emotions that sort of come up around this that prevent founders from doing what they can to make the most out of this situation?
Yeah. I can't speak for all the psychology behind why a founder might continue pushing. I think a lot of it boils down to just the optimism. The optimism in founding a company and trying to change something is like, naturally, you're going to see many paths forward because you've found many paths to get to where you are. And I think the challenge is like how you risk assess, how you probability weight those paths. How likely is it that, if with 6 months left, I don't have enough cash, I'll just sell the company. And like, that is an option, but looking at all those and then forgetting that there is an option, which is like none of those things work. And then you're left holding the bag. And at that point, nobody's really excited to be around to help you. And so you're like really flying solo in a way that even for a founder can be more lonely than ever. On the investor side, certainly like there's two dynamics. There's like the fund dynamic, depending on what a partnership looks like. Some investors might be afraid to take a write-off at a certain time. Maybe they already took one in this quarter or year or whatever. Maybe
they might be fundraising.
Maybe they're fundraising. Maybe they have something else going on in the partnership where like they want more security. Like they just don't want to like get bad news right now. I think that could be true in certain kinds of partnerships. And the other version is separate from all the weird dynamics that can exist there and are hard to see. Investors are also, one, optimistic, and two, like in the event that it's a zero is a zero is a zero. And so there's not a lot that I would do differently, purely on like the financial motivation. It's like, look, if I get back 50 cents on the dollar or zero, it doesn't make an enormous difference. It can certainly make a difference. And as a fiduciary for my investors, like I need to make sure I get as much as possible. There's a very, very strong argument that I can do a much better job spending time on the thing that's going to return 10x and then make it 10 and a half, than try to return half on the same size investment that could be going to zero. And so I think all those incentives, plus the fact that we're human and don't like spending time on things that are uncomfortable, all factor into the fact, like we'll just push off the discussion, the decision, and any action that suggests it's not working.
And by the way, it makes a big difference depending on how much follow-on has gone on, right? Like if all you've done is raise a pre-seed or a seed and you represent 3% of someone's portfolio versus they've leaned in heavily and you've raised 20 or 30 and this is like a big bet for them, like that's obviously going to make a big difference, right? Claiming 10 of the 20 of preferred makes a much bigger difference than just, one of your early bets that didn't necessarily work out. But sorry, Melissa, you were going to bring something up.
Yeah, I was just going to say, I think you make a really good point there, Sam, that is often overlooked, which is like VCs are also, if they're sitting on the board, right, that one person wearing the director hat certainly has fiduciary obligations to the stockholders of the portco in question, but the funds themselves and the partners also have fiduciary obligations to all of their LPs in the fund. And that's really where that time cost equation comes in. So I know, sometimes as a founder, it can feel a bit like things started going sideways and suddenly I'm here by myself, not able to get enough mind share from my investors about what to do. And there is another side to that, which is, exactly what you said. The investors have to be balancing their entire portfolio as well.
Let's walk through the actual process of selling. So, we've listened intently. We've written down all of our notes. Unfortunately, it does seem like, with 6 to 8 months worth of capital left, our best outcome is probably trying to recover some value for a sale. What's step one for starting this process? Do I get a banker? Do I do some stuff on my own? Sam, why don't you kick us off for that?
Step one, and I probably should have said this in the first timeline question, make sure the D&O insurance is in place. Like just be doubly sure, just to make sure that in the event that, you get too close to the line or daisy at the very end of the process. In terms of, I've seen this go so many ways, and I think I have less reps on this than either Brendan or Melissa, but the ones that I've been a part of I think of it as you have to choose, like, do you want to do this yourself or do you want to work with somebody to do it, like an investment banker or somebody else? And do it yourself, I've seen work more often because so many of these, like last minute sales are just a relationship. And so the minute you put an advisor in the middle, it makes it a lot harder to do. On the flip side, that means you are committed to this process. You have less time to run the business. You basically have no ability to like take a different direction or very little. Working with an advisor means, one, more exposure. You can run a real process. You get more people into it. Maybe it's a little less certainty of getting to a close with one of those people, but you also have somebody who's done this before, can see the signs, hopefully is like incented to see it be successful financially, and you can hand it. And the key is finding a really good partner on that side, because if you find, I'd say, I don't know what the percentage is, call it 5% that I've worked with or talked to are really high quality and can get you to something positive. There's a lot of people in the space who are playing the VC game in some ways. They're almost playing like an ABC where it's like, we'll take on 10 engagements and hopefully make money on one of them. And so it's really, really important if you're going to go with an advisor that you understand like what their incentives are, how much time you're going to get. Like, that is effectively like a whole other, almost like diligencing a VC coming onto your cap table. And so, that's like the first kind of like fork in the road to me.
I want to double down on something you said about relationships. And I think it's really easy for particularly a lot of like product founders to be really heads down and not build industry relationships. And, you want to get to product market fit. You're really focused on customers. You're not big enough to be interesting from a channel partner relationship or anything like that. But your business might have natural homes to it. And even early conversations to get to know the people who might buy you down the line, or to understand what's the dynamic in those companies. Because at any given time, you should probably know 3 or 4 people for whom your product in your team is a fit, and make sure that they like think highly of you and their values aligned. And that can just be like a couple of lunches or a couple of coffee. It doesn't have to be a really, really deep relationship, but even that, I think a lot of early stage founders like don't have enough of.
And I would say there may even be a half step before this choice about whether to engage an advisor or not, which is really taking a look at what your company's assets are likely to be in this situation, right? Like, do you have a tech stack that is going to be interesting to another company who may be in the position of making a build buy decision right then? Or is it your customer relationships? Is there a competitor that just wants to grow their revenue by taking some of your customers who would otherwise be wound down? Is it your team? Like, there's these different buckets. And I think the way you go about making that decision of who to talk to, whether to work with an advisor, needs to take into account what the likely outcome is and what your most valuable assets are.
Along those lines, I'll tell a quick funny anecdote, and I'm thrilled for the team. I was an investor in an entity which was the original startup behind Zero Hash, which is now, some news came out that MasterCard might acquire them for $2 billion. The original version of that company was aiming to build a commodity futures product for hemp and cannabis. And so they did the hard work of acquiring a CFTC license, and which is a really long process. There's a lot of legal work that goes on, and they did that successfully. And right at the beginning of the first Trump administration, Jeff Sessions, the AG, decided that hemp and cannabis was not cool. And so it scared all the counterparties away. No one wanted to trade in that business, so they kind of had nowhere to go. That team, we had 30 something cents on the dollar left in the bank. And they emailed all the shareholders and they said, this license has value. People spend hundreds of thousands of dollars, even more than that, to go through the process, and time, right? It literally took them a year to go out and get this trading license. We think this license has value. Would you like us to spend 11 cents on the dollar to try and get the dollar back? Or do you just want your 37 cents back? Every economically rational shareholder said, yeah, give me my dollar back. Go send, because the difference between getting 37 cents back and 26 cents back was kind of meaningless to most of the investors, right? They wound up doing exactly that, paid everybody off. Everybody got their dollar back. They sold the majority of that entity to a partner that then they got stuck in, that they never wound up being funded. And so they bought that company back from that partner, pivoted into Zero Hash, and then built a $2 billion company, none of which was foreseeable at the time. And, so when people saw their next round, a lot of my investors were like, oh, wow, those guys really saved the company. I was like, no, actually, we got our dollar back, because that at the time looked like the best thing. But long story short is, they had a sense that this license was something that somebody would pay a bunch of money for. And everyone sold. I don't have any regrets about getting my dollar back.
I think I just kind of on that though. I think something that we sometimes see is like in that story, like good on the founders for really taking a deep look into like what's actually valuable and not kind of kidding themselves. I think what's really tough is we sometimes see a lot of founders who are like, built this thing. We raised $2 million. I spent $2 million building this thing. Like this has to have value, but they have no customers, or they have very not meaningful revenue. And so kind of a trap that I think is tough is a lot of these founders will be like, I need to cut burn, see this thing through, like try and sell these assets, when really actually what was valuable was probably the team. And so they like just got rid of like pretty much the majority of their assets and are fighting for something that like buyers aren't really going to want. So anyways, just, yeah.
Yeah, no, totally agree. So So let's say I go start this process, right? And I put together my list and I say, hey, I have this team, I have this product, I have this thing, and I go out and I start talking to people. Now I still have 6 months cash left. Not totally dead, but maybe that's the most recoverable outcome is the best. How much should I be upfront with potential buyers that another round's probably not in the cards? Because I got to worry about them waiting me out waiting till my last dollar to make a bid, scaring my customers away. Maybe these are pseudo competitors or people that, might offer some similar products. So should I just be upfront about my situation, or I don't have time to be cagey about it? Who wants to jump in on that one?
Because it's a good question for your advisor if you have one. Because it's so situational. I think that it depends on the stage of the company first, maybe. In the earliest stages, you just don't have, there's less of the things that you might be potentially selling. And it can be a little bit more open. That's like, hey, we're this incredible team. Maybe we have some tech built and we're looking for a home for it. And in the end, at that stage, because you haven't built anything super specific, ideally you have a larger universe of buyers. And so the thing you're really selling is the competition is I could go over here, I could sell to Google, I could sell to Microsoft and be integrated into either cloud org, and both of them would care about that. Versus later on, it becomes way more. I have a CFTC license. I built a specific kind of exchange. There's 3 of those. Those are the only 3 buyers. I can't sell them. It's more valuable to them than anybody. And then it's actually easy to be explicit in a different way, just saying it's well, you kind of know who you're up against. And anyway, that competitive piece is the key piece. If you don't have any real competition or you can't find a way to create competition, then being really open about it is hard, and they will let you out. I think that is a field thing that bankers are great at. That's where advisors are super helpful, is good ones to understand that dynamic, and they can help you evaluate how your buyers, maybe they've worked with these buyers before and they just know what you're hearing and what it means.
And that's actually one reason why I would say in those situations, to Brendan's point about cutting team, that maybe cutting team is not the best early strategy, because any leverage that you have is I could sell to you. And if you don't give me a better deal, why is my team ever going to come and work for you, right? Whereas if you only have the product, there's no incentive to actually give you more for that, because you're not trying to convince a team to come and work to, earn, do the earn out or earn options or whatever. A good package would actually encourage a top tier team to come and work for that.
I think this is also where that difference between starting at 6 months versus starting at 9 months is really key, because you have a lot more room at 9 months to approach potential buyers with sharing less information about where things truly are at, crafting a different story with or without your advisors about, we're getting ready to fundraise, but I, as a founder, am not convinced that's the right thing for us now. Are you open to strategic discussions? Since, 6 months, it's already starting to get pretty tight. And if you start with that story and don't get bites, you've got a lot less time remaining to kind of share everything and still hope that there's something there.
Melissa, the language you use there, I think is interesting. And I'll even have just ever so slightly more positive tweak, is that anytime you go out for a fundraise, it's probably a conversation that you might want to have, right? Because you are making the decision, I'm going to go fundraise and I'm going to raise the bar for what acquisition is going to be acceptable to my investors. So I think even if you're doing well and you've created enough enterprise value, right? You could conceivably see a situation where you've only raised a seed and there might be a $50 million outcome out there for you, which, by the way, depending on your investor base and the size of those funds or whatever, might be worth having that conversation, especially in a highly competitive environment where you've got, the next company down the road who might raise a whole bunch of money and all of that sort of stuff. So I don't even know if it has to be, I don't know if this is the right fit, and more so the hey, just a heads up, we're going to start fundraising. So if you have interest in us, let's talk about what that might look like before I go and the price goes up to 200 after I've raised a Series A.
I mean, even in the
you should always let your VCs, not your lawyers, craft your messaging. Which
I think the thing you're describing, Charlie, also exists in the world when you're very successful. so many stories of IPOs are like you have a conference room full of bankers working on the IPO and a conference room full of bankers evaluating M&A options, because it becomes the last chance to like, great, you can IPO and be worth $10 billion. Or like it turns out Cisco wants to buy you for 15 to make sure that, they can access this before it gets into the market. And so that exists at many, many stages before. And you're right. It's like viewing that as a positive in the sense that like making the right evaluation is actually an easier way to approach it.
I had I remember, you go ahead, Brendan.
No,
I also had one quick anecdote about this is, back when I had funded a single platform when I was at First Round Capital, they got an offer for $100 million acquisition at the same time as they got a term sheet for $16 million for their, at the time, Series B. It feels so quaint to think about a $16 million Series B. Wiley had called me up and said, hey, what do you think I should do? And I said, are you asking whether I think you can take this 16 and go build a $500 million company? Yes, 100%. I have all the confidence in the world. Are you asking me as 50% plus owner of the company whether I think you should turn down $100 million for this business? Like, I will never suggest that anyone does this because I'm sure you'll have lots of ideas down the road. But I think closing the door on those kinds of outcomes is something that I don't know how many founders are conscious of each time they raise money. Certainly the VCs don't push them to think about that. Brendan, go ahead.
Oh yeah, the only thing I was going to say, just going back to what Melissa was saying of like the timing, the 6 to 9 months cash out, like corp dev teams are really sophisticated. Like they're really smart. It's similar to like the VC founder dynamics, right? It's like, this is all they do. They've been doing it for years. They know way more than you. It's really easy to go into Harmonic and be like, well, they haven't raised in 24 months. Like, to what you were saying, Charlie, it's like, I'm going to wait 3 more months. But if you're at 9 months cash out, the corp dev team is like, I don't know, right? It's like, they might actually be going out to raise. They might actually be doing this, and they have enough time to see it through. And if they really want that team, they really want those assets, they're going to jump and they're going to move a little bit faster. So, some of these data points are like pretty obvious and public, and corp dev definitely knows how to view those and choose a strategy based on that.
That's an interesting insight, actually. The idea of like going out earlier, somebody could tell themselves a story that like you might still raise, but clearly if you cut burn and somehow manage to get 36 months of runway, there's an assumption there that you're on fumes at that point. So, you mess up the story by making it last long.
Yeah, like all this data, like LinkedIn data, like you can see the head count, you can see everything, right? So it's just like, more time is that optionality is.
Brendan, I'll follow up with you. What do you think are some of the most like overlooked sources of value that you've seen in some of these wind downs?
It's the people. It's the people. That's what we were talking about before. Like, man, there is such a shortage of incredible talent. There's a huge spike right now for deployed engineers, which is like which literally like FDE equals a founder, right? It's like you want someone who can be like a product manager and who's technical and who can sell and like do all these things. Like every company, applied AI, whatever, they're hiring for that role. And they want founders, they want that startup DNA, and they want folks, they're scaling at insane rates. They need like hundreds of people yesterday. So being able to pick up a pod of people who have a proven chemistry, who've worked together for years, who have built something. Like, again, the whole, what we were talking about before, it's like most of the time what you built, right? Even if you got it to a few million in revenue, that's incredible. But like that team is so valuable today. So just do not discount, don't cut people. Like the shortage for technical talent's insane.
Love that. And you might have really scratched and clawed your way to get to your $2 million of revenue. But like, if LinkedIn's looking for an AI team, like your $2 million in revenue is not going to make a differance to their bottom line. They're not.
And you don't want to sell based on that, right? You don't want to sell for a 10x multiple on your $2 million revenue when they value your team at $100 million. Like the amazing outcomes people talk about with all the tech giants, and this is why they're the best acquirers, is they pay a lot of money like per engineer or something, which is obviously based on the period of time you're in, but also, if you're selling on a revenue multiple, like you're by definition in some ways discounting what you built.
It's also interesting when you go out and you try and hire top tier talent that you maybe have to stretch to afford. A tier talent is more easily sellable later on than the team that you can, sort of afford.
I mean, I think another thing too is like a lot of founders don't understand the like actual sale mechanics, like a stock sale versus an asset sale versus like an acqui-hire where there's like a non-exclusive license of the IP. Going back to what Sam was saying, a lot of times, even if you build something 2 million, the cost for a company, whether big or small, to actually integrate that software into their product is really high. They might just pluck your team, give some proceeds back to the company for your cap table, and do a non-exclusive license of your IP, and they will have you rebuild that entire product or something along those lines into the new company. So just like understanding these dynamics of like, yeah, just buying tech is like it's hard to integrate that. It's not as common as you think.
So Melissa, JD asked a question, and Brendan touched upon a little bit about the mechanisms of these sales. And when somebody offers, it's probably rarely going to be like just cash, and sometimes you get private, sometimes there's an earnout. What are some of the types of structures and things that one could get in a sale when being combined in another company, just for the sort of 101 and people following the chat?
Yeah, so usually in these situations, you're going to end up either, and so an acqui-hire is, when the team really is the core asset. And so it can take a couple forms where usually it's, all or some of the team gets offers from the buyer. Often there's a condition that a certain number of them have to accept those offers for the whole thing to go forward. And maybe specific individuals who must accept are identified as well. And then there can be cash going to the company, or it could be stock, but usually it's a relatively small amount. It might just be cash sufficient to allow the company to cleanly wind down, maybe get some money back to investors. And that can be given either for an agreement not to compete after these people have been taken. That's kind of the simplest form. Or it can be a non-exclusive license, like Brendan was saying, for the IP. If there are actual other assets that the buyer wants beyond the team, whether it's technology or contractual relationships or things like that, then you're looking most likely at an asset sale situation where literally, schedule out, write down every single code base you have, every contract that you have, and the buyer's going to say, like, we want this, 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 and this, and we are not taking any of the liability. That's all going to stay with you. Back end risk, all yours. Wind down risk, all yours. From a documentation and transaction expense perspective, that's a significant uptick from the two acqui-hire formulations. So, again, depending where you are, if you're going to get a lot more money for that, or get, stock for your whole cap table in a company that's doing well, then it's probably worth it. But those are some of the considerations. It's less typical in a distressed or quasi-distressed situation to have a complete, a merger or a stock sale where the buyer is going to take the whole business as a going concern, for the simple reason that the buyer has a lot more leverage in those situations and they don't want to inherit your liabilities.
So one of the things that a lot of investors sort of get frustrated about sometimes is that in these acqui-hire situations, somebody says, yeah, I really do want this team, and I'm prepared to offer this team a really nice compensation package. So in other words, a company goes to a particular product line and says, you have $5 million to go build a really great team. And the offer could be $5 million package that mostly goes to the team itself. And if you want to incentivize that team to come and work for you, despite what it says in the waterfall and the, preferred and all this sort of stuff, just because there's $5 million of value going to everyone doesn't mean that I get my money out. Some of it could come in bonuses team. How do companies wind up like getting around that? It seems a little, no one's going to cry a river for the investors, but can you talk a little bit about like how that works, and if there's anything that investors can do to try and reclaim more value for themselves? Maybe not at the expense of the team, but we put $5 million of preferred in, and the team's getting the whole $5 million.
Yeah, absolutely. This
I feel
is
like a crybaby asking that question, but
no, this is a very hot topic right now. Not so much in the situation we're talking about now, but when we are seeing some of these mega acqui-hires happening for AI companies, and that's exactly the thing, right? Like talent is getting massive offers from some of the biggest tech buyers, and the cap table is getting proportionately less in some way, right? And so, I mean, the biggest thing that investors could do, which has historically not been something that's included in venture terms, but which is beginning to be talked about now as a reaction to these transactions, is to actually negotiate protective provisions on the way into an investment that requires investor approval for an acqui-hire structure the same way it would for a merger or an asset sale. So that's one contractual protection.
Have you seen any of those get tagged on to the hotshot AI deals yet?
I haven't yet. I've seen them discussed at the term sheet stage with great frequency right now. But yeah, it's far from being a market term for sure. I think, when you are already in that situation as an investor and don't have that type of contractual protection, it's really largely about, is the deal being structured in a way that it's going to require some approval? And usually, a buyer is going to want to minimize risk to some degree by making sure that you have significant stockholder approval, so that leaves room for a conversation with the founder, the other directors about, we understand the situation we're in, and if I could get, 50 cents on my dollar instead of whatever, or get my money back instead of 50 cents on my dollar, we'll be able to sign off on this and decrease the risk profile of the deal, making it more likely to go forward. But at the end of the day, a lot of the time it comes down to negotiating, and also whether there's other alternatives, right? If the choice is between the team gets a nice deal, the investors get a not so great deal, or everybody gets zero, it makes it harder as an investor to kind of put your foot down and take everybody down with you. And not, that's often how these things end up shaking out, is just there's not that many options on the table.
One follow-up I want to ask about different types of structures is about earnouts. In my 20 plus years of investing, I don't think I've ever seen an earnout go completely smoothly. They always seem to give the company that's been acquired the short end of the stick, no matter how well you paper that deal, either by squeezing budgets and all that sort of stuff. Would you say that is the case? And is there anything that investors or founders can do to sort of protect themselves when earnouts are part of the deal, but you're ultimately working for somebody else during that period of time?
So earnouts, I agree with you. Like, they add a lot of complexity and they rarely work as they are intended to. And when the deals end up in litigation post-closing, it's usually because of an earnout. So personally, not a fan, but they do have their benefits of being able to bridge a valuation gap. If you are on the selling side of a deal with an earnout, the usual way to try and get some protection there is to negotiate some covenants with the buyer about what, whether they're going to take some affirmative actions to support the earnout, acting in good faith, that type of thing, or you agree on a budget ahead of time and to fund this budget for the next year and only be able to reduce it if it's proportional to reductions across the whole company, not just, the legacy business. But there has been some Delaware case law that basically said, hey, buyers, if you have these covenants, like, you actually have to follow them. And if you don't, the sellers are, they have a viable claim there. And so as a result, it has become even harder to get sellers to agree to those covenants. The market's moved there a little bit. And so I always tell sellers, like, when you're going into a transaction with an earnout, you basically have to get yourself in the headspace of the earnout is like the gravy, the frosting, whatnot. Like, don't go into this banking on achieving the earnout, because there's a lot of traps there.
Agreed. So I appreciate all the time you guys have spent so far. I have one more question for Brendan and a question for Sam. and then I'll let you go. Brendan, in the situations that you guys see, how often is it the case that it is likely that a founder is going to be left with some personal debt from this company, that they haven't done everything that they can to not still be on the hook post close and running out of money?
Oh, that's a good question. So like I was saying before, right? We tend to not work with like super insolvent companies because we don't run an ABC or any type of bankruptcy. Most of the time, we're redistributing capital. In those cases, it's incredibly unlikely that the founder has any kind of contingent personal liabilities. But like I was saying before, I think a lot of founders just don't realize they're signing up for personal guarantees. That's where we see it the most, right? It's just like, oh, we have 50K on this Bank of America credit card. And we're like, oh no, like that's not great. Or again, like they signed a lease for 5 years and the landlord just slipped a personal guarantee in there. They didn't actually have a lawyer's review it, anything like that. But again, it's actually far less than you would think, at least with the companies that we work with, which is great, which is what you want to see.
I know a founder who did a brick and mortar startup, and the first lease they ever signed had a personal guarantee. That founder left the company, and ultimately, years later, the company went out of business due to the actions of the people who were then running the company. And then the landlord came all the way back to chase that founder down after it had been years since they had signed it, and they like no longer had anything to do with the company. And this was just an individual who was sort of disassociated. So yeah, personal
That's
guarantees
awful.
you really have to watch out for. Sam, question I have about founder responsibility to investors and your expectations as an investor. If I get an offer, and is there a certain trade-off? Like I have and Melissa, if you want to weigh in on the founder's responsibility, I can get everybody 10 cents back on the dollar, but I got to go sign myself up to go work for some company that I'm going to hate for the next 3 years. Like, what do I actually like? Where is that trade-off, right? If I can get everybody their money back and I have to go work for someone that I hate for a year, I don't know, maybe that's worth it. But how do you counsel founders along those types of situations where they do have an opportunity, but it's not one they're excited about?
Actual conversation, and be very curious for Melissa's take on like the legal responsibility. But founders are not indentured servants. So if you don't want to go do a job and you're signing up for 3 years, that's not only not fair, it's just, it doesn't make any sense. And truthfully, what's happening is I'm getting paid for your time. If I'm getting proceeds from a sale and you have to go work for it for 3 years, like work for that money, then effectively, like I'm just garnishing your wages. So I think if the only thing that somebody is willing to do is to sign you up for a 3-year contract, something like that, we have to reflect on the fact that you're getting paid for your time. We're not getting paid for selling the company. And that might weigh into like how we think about, that option relative to other ones. In that case, I don't think that it's even a discussion of like whether we're selling the company that much.
Years ago when I was at Union Square Ventures, we had funded this company that Yahoo had bought. And I ran into the founder, Josh Schachter, at some tech event, and he was still at Yahoo at the time. And he wasn't often in New York because he had moved. And I asked him like, oh, how long are you in for? Meaning, how long are you in New York for? And his response was 18 months, 3 days, 2 hours. And I was like, no, not how long how much time you've done there. Just how long are you staying around New York? And he's like, oh, 2 days. So I really felt for him.
I think there's a common thing. I think that even in the case where it's just a normal earn out or a normal vesting period or whatever, there is that feeling. So I can't even imagine if it was like, no, the only value came from you joining the company. So frequently I find that in that exact conversation I was just mentioning that we were having this talk, it turns out that you can actually pivot the conversation and say like, well, that's not on the table with the buyer, and be like, that's not a thing. We can talk about my employment contract. Let's do that in parallel. But the deal is this. And I find that redirectment can help you avoid that situation. And it's just not worth even considering something that's weirdly structured like that.
Melissa, does the founder have a responsibility to join a deal that pays back their shareholders if it's on the table?
No, I mean, this is where the multiple hats come in again, right? There's the founder is probably a director of the company. And so, like all of the directors, has to exercise their fiduciary duties and take into account, what as a whole is in the best interest of the stockholders. But the founder as an individual is absolutely not required to personally sign up for any type of employment in order to get to that result. Yeah, there's I have seen founders go the other way too, right? Like I've had founders who did sign up for a deal and then were like, how can I take some of this compensation I'm getting and give it back to my option holders who are out of the money? Like there's a lot of creative thinking that goes both ways on these things. But as far as legal obligations, a founder never has to take a job to, for the sake of keeping a deal on the table.
Great. Well, on that happy note, I really appreciate all of your time today. Super helpful, super informative. And what's the best way to reach everyone?
I'm pretty easy to find on the Gunderson website or
Nice.
LinkedIn, Melissa Marks, the one with the crazy hair.
Gotcha.
Same.
That's
LinkedIn.
also how I describe myself too.
I'm the same. LinkedIn or Sam at PSUM.
Cool. And
Yeah,
Brendan, if
LinkedIn.
we need Sunset services, how do we find you?
Yeah, LinkedIn, sunsethq.com, Brendan at sunsethq.com, any one of those.
Cool. Thanks everyone for your time. I appreciate it.
Thanks,
Have a
Charlie.
good day.
Yeah.
Bye all.